If you're a tech professional, chances are restricted stock units, or RSUs, make up a significant part of your pay. But here's the thing. Most people I talk to don't fully understand how they work. When do RSUs actually become yours? How are they taxed? What should you do once they vest? And what's the risk of holding too much company stock? Hi, I'm Jonathan, founder of Alpine Road Financial. I've earned RSUs myself and made the mistakes. Now I help others like you avoid them. So whether RSUs are brand new to you or you're just looking for a better plan, this is your guide. First, let's start with the basics. RSU stands for Restricted Stock Unit. Restricted means there are strings attached. You don't own anything yet. Usually you have to stay employed for a specific amount of time before the stock becomes yours. That's the restriction. It's like signing a 4-year contract. If you don't make it through that contract, you don't walk away with all of it. Stock unit means it's a promise of shares, not actual shares today. They're like little IOUs that turn into real stock once you meet the conditions. Think of RSUs like a movie ticket voucher. Right now, you're holding a voucher. It's not a seat yet, but it's a promise. Once the showtime, i.e. your vesting date arrives, that voucher turns into a real seat in the theater. Just like that, your RSUs become a real share of stock. One RSU equals one share of stock. Simple as that. But what it does is it acts like a delayed bonus that aligns you with the company's success and incentivizes you to stick around. The bottom line, RSUs are a promise of shares, not cash. But once they vest, that promise becomes real ownership in your company, which is pretty cool. So why do companies offer RSUs instead of just paying bigger cash bonuses? Because RSUs benefit both sides. For you, they grow far beyond what cash would. When the company grows, your wealth grows. For the company, RSUs encourage loyalty, retention, and alignment. They reward you for helping increase the company's value. RSUs turn you into a partial owner, not just an employee. You're not working at the company, you're growing with it. That's a powerful incentive and leverage if you understand how to use it wisely. So let's make this real. You're sitting in your annual review. Your manager says, you had a great year. We're giving you a $15,000 raise and a grant of 100,000 RSUs. Your brain does quick math. Say your stock is trading at 50 cents on the stock exchange. 100,000 RSUs times 50 cents a share equals $50,000. That's a big win. But here's what's really happening. You don't own those shares yet. They're just a promise, a reward that will vest over time. The stock may go up, which is awesome, or it may go down, which is less awesome. The value today is just a snapshot, and you will not pay taxes now. You only pay taxes when the RSUs vest and they truly become yours. For example, 1 year after your manager gives you those 100,000 RSUs, you hit your cliff and 25% of those RSUs vest. So you vest 25,000 shares on that day. And let's say the company has kicked butt and now the stock has grown from 50 cents on the grant date to $1 a share. You have now benefited from your company growing and made $25,000 that's added to your income, and that's what you owe tax on. Taxable income is based on stock price on vesting, not at grant. That's the RSU journey. Granted today, vested later, and taxed when it's real. So let's spend some more time on vesting. Most RSUs follow a time-based vesting schedule. For example, 25% over 4 years. And most companies I see use a 1-year cliff, followed by monthly or quarterly vesting. So what's a 1-year cliff? A cliff means nothing vests until you hit that first anniversary. After that, you start vesting regularly. Here's a quick example. To make the math easier, you're granted 4,800 shares with a 1-year cliff, and after that, a monthly vesting schedule. So after 12 months, you vest 1,200 RSUs, which is 25% all at once. Then every month after that, you vest 1/48th of your grant because there are 48 months in a 4-year grant, which is 100 RSUs per month for the next 3 years. Now to recap around this cliff, if you leave before that 1-year cliff, you'll walk away with nothing. But after the cliff, you stay and you start unlocking shares every month going forward till you completely vest all your shares that were granted. One thing to call out, If you work at a private or pre-IPO company, you might also have performance milestones in addition to time-based vesting. These could include hitting revenue goals, completing a funding round, or shipping a major product launch. These become your vesting restrictions. In other words, your RSUs won't vest just because time has passed. You'll need the company to hit specific goals first. So circling back, remember these terms. Grant date. This is when your RSUs are awarded by your company. Vesting date. This is when a portion of your RSUs become yours. Your taxable income is based on the stock price at vesting, not at grant date. To drill this point in, if your RSUs vest at $1 per share, that's the value you're taxed on, even if they were worth 50 cents a share when you got the grant from your manager. So now you got them. Do RSUs expire? Yes. RSUs can expire if they don't vest within a certain time frame. Many RSUs, especially at private companies, expire 7 years after grant if they haven't vested. That means if your company stays private for a long time, or you leave before your shares vest, you can lose the unvested shares entirely. A pro tip, always check your RSU agreement to understand your vesting terms and your expiration window. So pulling it all together, we're gonna talk about taxes next. But for now, log the idea. Vesting isn't just about time, it's about timing. Knowing when your shares vest and when they might expire is the key to managing your taxes, cash flow, and career moves. This simply allows you to plan accordingly. So now we move on to taxes. This is where most people get tripped up. On the vesting date, the IRS treats your RSUs like a cash bonus. Let's say 25,000 RSUs vest and your company's trading at $1 per share. That means you just earned $25,000 of ordinary income. And these RSUs are taxed just like your salary. So you pay federal and state income tax and payroll tax, which is your half of Social Security and Medicare. But here's the catch. Your company usually covers these taxes by withholding some of your shares. Essentially, selling some stock on your behalf and releasing the remainder to you. The problem. Most companies only withhold 22 to 24% of federal income taxes, even if you're in the actual tax bracket of 32 or 37%. What this means is you could owe more at tax time because you owe the IRS more than the company withheld. Okay, so you have shares now as a batch has vested. At this time, you can either hold or sell them. If you choose to sell later at a higher price, you owe additional tax. Wait, did I just say RSUs are taxed twice? That's a common fear, but it's not true. If you track things properly, here's what's really happening. At vesting, you're taxed on the value at that moment, just like receiving a cash bonus. Then when you sell the shares, you're only taxed on the growth since vesting. Think of it this way. You're taxed once on the income you received at vesting and taxed again only on the new gains when you sell. You're not being taxed twice on the same dollars. You're taxed on two different types of income. Ordinary income at vest, capital gains after vest. Just like any other investment, the growth is taxed separately from the initial value you received. We talked about this a bit earlier. Most companies withhold shares to cover taxes when your RSUs vest. So if 25,000 RSUs vest and they withhold 22% for taxes, you might only receive 19,500 shares in your brokerage account. But that doesn't mean you're done. If your actual tax rate is higher than the amount they withheld, you'll likely owe more at tax time. So what should you do? Two common approaches. First, calculate the underwithholding and sell some shares immediately to cover the shortfall. Two, or sell all and diversify right away. Let's talk about why this second one is a smart move. Here's the question I always ask my clients. If your company gave you $50,000 in cash, would you turn around and buy $50,000 of your company's stock? If the answer is no, then maybe you shouldn't hold your RSUs either. Here's why. You're already exposed. Your salary, your bonuses, your benefits, and your job security all come from one place, your employer. Now imagine adding more risk by holding their company stock too. That's called concentration risk, and it can grow quietly over time. Holding some stock might make sense, But betting your entire worth on one company, that's rarely the smart move. So how do you plan around your RSUs? There's no one-size-fits-all strategy, but here's what smart planning often looks like. First, estimate how much income your RSUs will create this year. 2, adjust withholdings or set aside extra for taxes. 3, use proceeds to benefit other goals like IRAs, 529 plans, sabbatical, or a down payment. 4, unwind large positions over time, not all at once. And 5, explore charitable strategies for appreciated stock. The bottom line, your RSU plan should align with your life plan. Now, what changes in an IPO? This is where it gets spicy. If your company is going public or being acquired, your RSUs might convert to new company shares, accelerate vesting, or be swapped for options or cash. Every single deal is different. Some RSUs become taxable immediately upon IPO. Others still vest over time with a lockup period. And your entire tax plan may need to shift fast. This is where it really pays to have a plan for a planner like me. So here are my final thoughts. RSUs are real money, but they come with real complexity. They're not just bonus shares in your account. They're income, they're risk, and they're a powerful tool if used wisely. In summary, there are 4 big takeaways I want you to walk away with. First, know your vesting schedule. Second, prepare for taxes. 3, do not let company stock dominate your portfolio. And 4, use RSUs as a lever to buy back your time, invest in your goals, and to build lasting wealth. And remember, if your equity is worth a lot on paper, you still need a plan to turn it into real wealth. Let's turn your RSUs into real freedom, not just financial complexity. Click the link below to book a call. I'm Jonathan, ex-tech, now a fiduciary, helping tech professionals like you turn your equity into clarity, confidence, and control. See you in the next video.